Hey everyone, it's Imran from Options Insight with another macro options spotlight. Remember, like, subscribe, comment, ask questions. We want to get this stuff passed around so more people learn about options. Okay, bad day for US. Down another percent and a half. Russell actually leading the way, down 1.5%. We kind of had expressed that that's got slightly more junkier names in it, which had squeezed pretty hard, and we thought that buying puts on that wasn't a bad shout. Seems to be materializing. But to be fair, people buying puts on S&P as well, starting to see some protection buying coming in there, really driving up the volatility side of things on S&P. We can see that here with all these US indices up around 1 vol, bit more than 1 vol. Europe and Asia did outperform spot-wise. See here, China up 2, Europe up 1. That has dropped a bit overnight, so starting to catch up with the US as the US does continue to trade lower. We've got 40.50, the level now on S&P roughly, down another almost 1% from where we closed yesterday. Gold also being weighed down by the dollar that's holding on to that bid and higher real yields in the US. And we think some longs are being tested there, right? That's been a straight line move up from the lows in gold. And it was in need of a correction, and that seems to be playing out now. We still think there may be a bit more downside in gold, down towards that 1800 area in the spot price, which is probably another sort of 2 to 3% lower. But that's probably going to provide you, in my opinion, with a pretty decent dip buying opportunity for longer term longs in gold. Certainly if you think the dollar has topped and is headed lower. Okay, and then lastly, oil bouncing overnight. So it was under a little bit of pressure yesterday, bouncing overnight. Russia saying they're cutting production voluntarily in response to the price caps that are being implemented by Europe. So that's knee-jerk the price up a couple of percent. We'll see how long that persists. But that's kind of the news that we've seen. And we did see a little bounce in copper, which has faded, and uranium still hanging in there. And finally, nat gas bouncing from the lows, but nat gas kind of languishing down there at that $2.50 level, which does seem pretty beaten up right now. So wouldn't be surprised to see some sort of reaction off that level. But in general, the fundamentals don't look amazing for nat gas right now. Vol-wise, we mentioned US vols were bid, Europe vols drifting, and China vols fairly unchanged. Commodity vols finding some support in precious metals, but then down everywhere else. Nat gas down about 4 vols there. And we did think that gas vols at 90 do probably look slightly better to sell, but realized is 82. So it's not a no-brainer. You can see the carry here in commodities. Most of it is actually neutral to negative now. The only sole one still in green is copper, and even that is a lot less than it was. So generally, commodity vols have been heading south as realized have been ticking slightly back up, and that's kind of made all that carry drip away. We do still see this massive positive carry appearing in Nikkei, realizing 5 just can't really budge right now. But outside of that, S&P's flipped positive. Now you might look at those numbers and be that doesn't make any sense when the realized is at 19.87 and the implied is at 18. That's because the way we calculate carries, we take the average of the 1 month vol and the 1 week vol. So there is a 1 week optionality in the S&P that's catching a bid and is actually more in the 20s. And that is why that carry number is positive, because if you are selling gamma, you're not necessarily always going to sell the 1 month vol. You might sell 1 week vol. And if that vol is trading at 22, 23, then arguably there's some positive carry to extract from that, basically. So just something to be aware of there in terms of how we do our calculations. Okay, moving on, sentiment and positioning. So, sentiment got pretty beaten up back end of last year, end of Q3. That kind of triggered a bit of a bounce, bit of a short squeeze. And we see this AAII bull bear survey, and that has swung pretty violently back up. So that's the orange line. The lows here at the end of Q3, it swung all the way back here, back into positive. So it was at minus 45. It's now at kind of positive 12.5, something like that. Okay, and the pink line is the S&P and how that's tracked that. So sentiment's kind of got a bit stretched to the upside here. So don't be surprised that we're fading now as all those people got forced back in. Now, looking at the CTA side of things, we've also been saying CTA's got forced back into the market. This is a model from Goldman's where they do their own number crunching, and they've seen CTAs pile back in, having bought approximately $120 billion worth of equity exposure in the last month. And now what they are saying is these CTAs, remember, these are momentum models generally. So if prices go up, they're going to keep buying. If prices stay still, they're going to keep buying. If prices go down, they're going to have to sell again as that momentum gets destroyed. So they think there's quite a lot of convexity here in terms of flat tape to up tape. There's a bit to buy. It's not crazy. But in a down tape, there's a hell of a lot to sell. And they're talking in the order of magnitude of $213 billion if this market was down over the next month that would need to go out the door. So this line here really showing that there's a lot of downside potential tail risk from the CTA community if we do find a reason to go lower. Okay, so that's something to be aware of, and we don't think the skew in the S&P is accurately reflecting that tail risk, basically, because that skew has compressed back down and it's kind of not that far off the lows. And then lastly, the capitulation that we mentioned in the long-short quant universe, the squeeze in unprofitable tech hitting nosebleed levels, books getting degrossed, all these things are kind of signs that we kind of getting to the end of the squeeze. So a retracement of at least half of those January gains in things like ARK, things like Russell, is not out of the cards at all, given that all these shorts or a lot of these shorts have been covered. And bear in mind, discretionary traders are likely going to wait for next week's CPI. So we do think systematic money is kind of the marginal determinant of where this market goes in the near term. And we know if we do go lower, the systematic money is going to be getting out of Dodge. Okay, so that's something to be aware of. Sticking with the systematic theme, volatility control, right? So speaking of systematic, Tier 1 Alpha do a good job of tracking what these guys are up to. And what they've been saying is, as realized volatility has been coming down over the last couple of months, since say November, where it peaked up here, it's been heading lower. When that heads lower, these guys need to add length. So you can see the volatility control implied notional flows. This was kind of their equity length, and it's going back up basically. Okay, so it's still not massively stretched to the upside, but it has had a strong recovery since November. And so what tends to happen is when realized vol comes down, these guys have to add exposure back to the market. When realized vol goes up, they take exposure out of the market, right? So these green bars show when they're a net buyer and the red bars show when they're a net seller. Okay, so these guys put out a free newsletter every day where they track all these things amongst other things. Now, what they did flag is there's a 5.5% rally that was on the 10th of November last year, which was one of those CPI days where CPI missed and the market just ripped to the upside. Okay, that data point, that day is dropping out of the 3-month realized sample today. So that means you're going to get this shift lower. If we don't get a 5% move, let's say we get a 1 to 2% move like we have been doing recently, then that realized vol 3 month is going to drop by a good few points. And these vol control guys on the back of that drop in realized are going to then be putting more money to work. So in theory, there's potentially $2 to $3 billion needing to be bought from the vol control universe if the market can manage to stay in the plus 1.5 down 1.5% kind of range, basically, right? So that $3 billion of buying, if it comes, may actually help support the market and stop it from evaporating, as it has been pretty weak over the last few days. So if we were to pop back above 4,100 on the back of something like this vol control stuff coming in to buy, then the question is, do you want to use that opportunity to fade this market going into CPI next week? And that depends on your expectations of CPI. I mean, I do think the market is repricing down for a more hawkish type CPI number. So then the risk may actually then be to rip higher again, right? So these are the things. The market's always trying to front run the next move and figure out what's going to happen. And so whilst we were up at 4,200, everything was great and people were happy. But now few protection buyers came in getting nervous of next week and the market's starting to change its expectations. So we need to be aware of that. The fact that the VIX has caught such a bid, we think VIX puts maybe are going to be a good way to fade it if you want to look for a trade that will do well on an okay CPI that doesn't actually come in hot and comes in flat to lower. Then you're going to get this big rip in markets. And you're going to get this big reset involved. So maybe VIX puts are going to be something to keep an eye on early next week. Okay. And then kind of moving on to what else I'm seeing. So uranium. So we've got our dashboard here, kind of screaming out in the commodities space as the cheapest vol. Both from a realized perspective, it's carrying -4, so it's doing pretty well there. And the buy, we're down here in buy straddle. So spot is relatively neutral right now because it's had a little pullback from the highs in terms of URA anyway. And vol historically is quite cheap. So you see here, implied vol has just been kind of going lower for ages now. So now, obviously, we don't tend to trade URA because we don't really like the liquidity very much. You see that shift down there in vol as well. So we like using Cameco as a proxy for uranium vol. Okay, that's it. Have a nice weekend. I'll catch you all next week. Cheers.